As a contractor, I don't pay for materials I don't use. So why would I pay for stuff I don't need in my mobile plan? That's why the new MyBiz plan from Verizon Business is so perfect. Now I can choose exactly what I want, and I only pay for what I need.
Right now, with MyBiz plan, get our best price, as low as $25 a line. Visit verizon.com/business to get started today. Price per month with 5+ lines. Includes autopay and paper-free billing and special intro offer discounts. Taxes, fees, economic adjustment charge, and terms apply. Offers end June 10th, 2025.
Reality radio for a really great future. We're talking real money.
Hola, bonjour, ciao, konnichiwa, salam. Welcome to Talking Real Money. Welcome to Talking Real Money.
Cookie Monster
International
financial.
Don't know what I did. I was trying because we're doing international in this episode.
Okay.
So I was trying to be international in my approach to saying hello to everyone.
It was good. I liked it.
Thank you.
Yeah, right up to the Cookie Monster thing. You were doing pretty well.
Cookie.
Yeah,
Me want better. Cookie. Love cookies.
Always. Yeah.
Welcome to Cookie Edition of Cookie Real Talking Cookies. We're talking cookies on Cookie Monster Show.
I'm calling you Cookie.
I like chocolate chip. Anyway. I don't know where this episode's going. Tom just vanished in the distance.
I couldn't take it.
Good thing nobody can call these episodes, isn't it? Isn't that for the best?
No, because when they call in this circumstance, when you and I get this way, they just ignore it. They always, if you notice, they go right to the question. They just go, all right, well, here's what I'm asking. You know?
Long-time listener, first-time caller. What's the, should I be in an annuity?
I know. They just totally just go right by it. So that's fine.
That's all right.
We'll do the same.
We'll do the bad humor. Yeah. You don't have. We do the bad humor, so you don't have to.
Well, and that's one of the questions. I'll talk about that in a minute. So stand by.
Really? That's one of the questions. Really?
Yeah.
Okay. Questions coming up at the end of the episode.
Exactly.
That kind of question.
So
okay.
Stay tuned for that.
All right. So what we're going to talk about right now is how many of you over the past 10 years, maybe more, have said, why would I want those stupid foreign stocks when I can invest in the greatest economy in the world, the United States of America? So I'm only going to buy the S&P 500 because it's the only thing that's going up. It's going up, and those foreign stocks are going nowhere. So I'm just going to own U.S. How's that working for you so far?
This year?
This year.
Not the best. The S&P through the 21st of April, we're recording this on the 23rd.
I don't know, but it's not airing until probably May.
Is down about 10%.
Was down since we're doing this in May.
Thank you. Meanwhile, international small cap value up 10.9, et cetera. There's other international parts of the market that made money.
There are other economies in the world that make money?
Emerging markets, stuff like that, places most people don't invest. And it's not, I don't think it's necessarily returns. I think it's what you just said. They feel like I live here. Mm-hmm. I know it. I know this economy. I trust it. I want to put all my money here. It's not just us either, by the way. Go to Germany, same thing. Japan.
We have had calls from listeners in Canada who have said the same thing, that they have very large portions of their portfolio in Canadian stocks. Yeah. And there aren't a lot of Canadian stocks.
We got the one that makes the phone.
Not anymore.
They're still publicly traded.
Are they?
Yeah. Blackberry? I believe so.
They have a product?
I didn't say it was a good product. I said I used it for many years, and I really enjoyed it.
Just because you used it doesn't.
That's all
my
that matters.
Goodness! Yes, they are publicly traded.
There you go. How's that looking? Don't ring that up soon.
Well, let's just take a look. Their current price. Well, let's see. Back in their heyday, and it wasn't that long ago, 2008.
You used to do voice work for them.
I did. I would do their conferences. Ladies and gentlemen, welcome to Blackberry World 2013 or whatever it was. In 2008, that was their peak. So it must have been before that I was doing those. Okay, peak in 2008 was $144 a share.
U.S. or Canadian?
I'd be U.S.
Okay,
be U.S.
Yeah, real money.
Current price. $3.07.
So you took a bit of a hit on that one, then.
share, yeah.
That's what you're saying. You didn't get paid in stock. They didn't give you loonies, right? They gave you dollars.
No, the fee back then, and I did the conferences live. These days I record them. So I did it live, and the fee back then was $150 an hour minimum, 4-hour call.
But you went to the hall to do this.
I did.
Yeah.
And it's funny because I just did one for a conference. Well, actually, I just got the job. I just got hired for it. I did an audition for it yesterday, and I did one for a conference, and it's about $250.
For the whole thing?
Easy. Well, it's not as much stuff, but it's all recorded.
Just
I'm not
record it,
sitting
send
there
it
the
to
whole
them.
time. Yeah,
Somebody
I just
clicks the
record it.
button.
And you know what's
it.
funny is that so many of my jobs now are not in that ladies and gentlemen voice. They're in, like this one is, it's in my my cowboy voice. I'm doing it in my cowboy voice.
Because you did that video for somebody in the out west here for the cowboy thing for the promotional video.
I did a promotional video for Montana
good one.
ranches. I did a Super Bowl video for Sweetwater beer. Big
You are a
horses.
good Western guy. Okay.
I know. I'm telling you, I'm just going to change
Next
my voice
time
for
I want to
this.
reenact the shooting at OK Corral, I'll give you a call or
Big
something.
me. You just holler at me, boy.
All right.
I'll be doing it.
Y'all come back now. Yeah. All right. Okay. So U.S. versus international. This is a debate that goes on ad nauseum. I can actually remember in 1999 when I was
remember,
which is not easy to do, but I was at a conference with the great Paul Merriman, and he was speaking to a large group of investors in San Francisco, and he got up and said, "You need small companies, you need value companies, and you need international companies." A lot of people got up and left the room. I was at the back, and I'm asking, why are you going? And they said, "You don't need anything but the 5 best tech stocks.
Yep.
You guys are stupid. You don't know what you're talking about. And you certainly don't need anything
That's
outside
sort
the
of
US.
the Motley Fool attitude
was.
of the years ago, yeah.
They just told you only buy the companies you understand. Sure. Explain the business model of Amazon to me. And let me tell you right now, it doesn't directly relate to the package you're getting delivered by a drone either. So anyway, let's talk about U.S. versus international, because the year has changed. And now what are you seeing? You're seeing the experts, the smart money, is buying international stocks.
Wait, buying international or buying U.S.?
Buying international
You mean
stocks.
after they've already gone up some?
Well, there is that, of course. Yeah.
Because the attitude is they're going up, not they've gone up. It's that tense issue.
Thank you. That people forget.
Which makes me so tense.
It does. I can see you're all tensed up there. So we call your counselor.
Chill pill.
That's been harsh on U.S. stocks, which we mentioned have gone down quite a bit. Most parts of and by the way, it's been hard on the dollar. It's at a 1-year low, among other things. But okay, going back, since 1975, U.S. stocks have outperformed those of international stocks for stretches of about 8 years. Does that have a familiar ring to it? Because don't we talk about that period, the lost decade from 2000 to 2009, when the U.S. market made less than nothing? It actually went down for that period of time, and international stocks and small stocks, those things went up. But so it rotates. It has a tendency to, one's better for a while, the other one's better for a while. And here's the hard part. They don't call you in advance to tell you which one's going to be better. But that's probably why, Don, you should be invested in all of them.
All of them. That's
all the
what
time.
I've been saying forever. And people continue to poo-poo that advice. You should always own the planet, because you do not know. You may feel it, but feelings aren't knowledge. They are worthless. You do not know where the greatest growth will occur. And yeah, sometimes U.S. and international stocks go up at the same time, but occasionally they don't. It's just enough of a difference that having them all can smooth the bumps out of that incredibly jarring road.
Yeah, I got to ask you, if you're one of those people that is now part of the great rotation from U.S. to international, are you chasing returns or are you market timing?
Well, I think you're both.
Yeah, you really
are.
Yeah.
Because that's what market timing really is: fleeing fear and or chasing returns, depending on the Well, depending on the general sentiment of the investment community at that time.
And depending on which part of the market you're looking at, there's a wide variance this year. The S&P 500, as of the time of this recording, down about 10. International small cap value up about 10. I think that's about a 20% difference, correct?
My goodness, that's volatility enough that
it's a lot
I think
of
I may
volatility.
need me a lorazepam.
Take a couple of those. You got to draw your words out when you speak her language, though.
Lorazepam.
Ma'am, yeah, missed that show already. So, okay, but people are asking us, is it time to add money overseas? And the answer is, it's always time to add money overseas. This is nothing new. This is okay. Go back to Japan of 1990. And those of you old enough can remember what it was like. Japan had, I think it was the largest market capitalization, right, in the world at that point. In terms of stocks?
And then it didn't.
Well, I'm getting to that. And they were running around the world telling people how to manage their companies. They were buying golf courses. It was all about Japan. And guess where the money was going? Japan. And guess where the people of Japan invested? Japan. And then guess what happened? For a variety of reasons, the economy went into a fairly stagnant kind of situation for a very long, I'm talking very long period of time, to where you had to wait for the Nikkei to get back to that high of 1990. You had to wait till 2024. 34 years of basically nothing.
Now, I do want to qualify that a little bit, though, because that's that same argument that a lot of folks who are trying to scare you about the U.S. stock market or the overall stock market use to when they go back to the Great Depression and they say it took you until 1955 to break even. Well, not really.
Because that does not include dividends then.
It does not include dividends.
Fair enough.
And the fact is that pretty much no one just purchased at the top and never bought in
Okay,
again.
fair enough. I mean, your returns are always idiosyncratic.
Anytime we make a statement like that, I want to try and put it in perspective.
But you would have been better off from that point forward to be globally diversified, whether your money was in yen or dollars. Either way.
Although
correct?
most of the world until recently has really had a yen for dollars.
Exactly. I keep my yen to myself. And this is one of those rare times, by the way, where people have been asking, hey, should I be more international? And we're going to tell them you should always be international. Let's talk a little bit about some of the biggest funds, though, Don, because I think you're going to find this interesting. I did the little research. You'll be proud of me for this.
Oh, good for you.
Yeah.
Research.
So VT,
I do most of the research.
I know. You're usually the VT, which is the Vanguard Total World Stock Fund, right?
Mm-hmm.
Yeah. Do you know its U.S. to international ratio without looking it up?
It is. It's about 65-35, somewhere
close.
in there.
61% U.S., 37%.
Yeah, it's gotten a little out of balance.
Yeah.
To me.
But it's large blend too, so it doesn't really have much small in it. I mean, that's okay, but prefer to see you have some small. How about AVGE, the Avantis Global Equity Fund? What is the stock?
I would guess that
US?
Would be closer to 60-40.
64%, or pardon me, 68% US,
almost
32%.
70-30.
Yeah. Mm-hmm.
Oh, I love that tilt. I like that tilt.
I thought you might, but here's the winner of tilts, DFAW, the dimensional
70-30?
71% U.S., 28% international.
DFA, loving you guys.
But here's the thing. Here's another consideration. AVGE is, when you look at it from the style box standpoint, large value. Mm-hmm. DFAW, really large blend. So you're getting more of a value
DFA
tilt.
is less value than Avantis.
Correct. That's right.
That's interesting.
Yeah. So things to consider, because that's the other thing that comes up often as part of our program is people say, okay, how do I invest in those international stocks? What would you tell someone who asked us that?
There's one of two ways. You either get a fund that is global in its investments, which is probably the easiest, or my advice is to lean more toward international than U.S., a little bit, not more toward it, but more than that 70-30 U.S. to international. I think that we're closer on the VT side.
So, but I'm saying which fund? So you'd say either one, a global fund.
Because I like the tilts of Avantis and DFA. I would probably go with the Avantis.
Okay, but so you would use a
AVGE,
global. But it wouldn't be.
AVGE.
It wouldn't be like a U.S. fund and then an international fund on top.
No, because then I have to rebalance.
It's harder work.
Right.
Yep.
And speaking of performance, I just went back and looked at one Japan fund, the Fidelity Japan fund. The reason I looked at it is because it goes back to 1992.
Yep.
So it has a lot of history.
Sure.
It's interesting, and this is what we were talking about. You said it took until when to break even?
2024.
2024. But that's the index.
Yep.
When you look at the fund itself with all that happens along the way with dividends and changes to the index and the like, that fund, $10,000 invested in
92.
Yep. Would be about $41,000 today.
That sounds better than than the index. Yeah.
Basically, just buying and holding diverse portfolios tends to bail
okay, but
you
what
out.
That 10,000 in a, let's see, what fund could I pick that'd been all those years? That would be a global fund. It'd be hard to find. You couldn't find it actually that I know of.
No, let me see what the global.
I could go look at IFA's index and tell you.
I think probably the oldest global index is VTS.
SAX.
Is it
VTSAX? Yeah.
Yeah, the total stock market. And that goes back to...
Not that far.
Hold on. I'm going to see how far it goes. No, it goes back to 92.
Oh, okay. So what would that 10,000
Near the beginning. In fact, it goes back to April of 92.
Oh, wow. There you go.
So that 10,000... Oh, you want this number? Oh.
Okay.
All right. Yeah. This will tell you why you want to have diversification.
Okay.
This will definitely tell you that. If in April of 1992, that was how many years ago? 34?
3 years?
34 years.
Well, no, 33
years.
92 to 2025, yeah.
Over that third of a century,
yeah,
your $10,000 investment would be today on April 22nd, so almost exactly 34 years later.
33 years later.
33 years later.
Okay.
Is $233,000.
So would you rather be focused on the economy that's been the absolute best, it's all about Japan, or sprinkle some of that money other places?
Yeah.
Wow, that's significant. That should tell you really everything you need to know.
Diversification bailed you out. And it's interesting, that 32-year time frame, 33-year time frame is pretty much the time frame of a typical retirement investor.
Good point. Yeah.
So you didn't really have to do anything. The $10,000 became $250,000.
And I feel bad that we buried the lead. This should have been 15 minutes earlier, but that's okay. It happens. So, all right.
My gosh, we are way into the show, aren't we?
I know. That's what I said. That should have been the open. All right. So this is This is a comment. Now. Mm-hmm. I'm going to tell you right now.
Oh, please. It's
going to hurt your feelings, okay? But
it's always hurt my feelings.
I know. You're a very sensitive soul.
Well, if you had my childhood, you would have been more sensitive.
We're not going to get it. Speaking of counseling, we don't have time.
I need counseling.
No, we don't have time for that. That's a different program of which...
Tom had the perfect childhood.
Close enough. All right. Richard from Lancaster, Pennsylvania. He's setting us straight. He said, we had $1 million invested. You take out 4% a year plus inflation.
Oh,
This is the you'd have $1 million, take out 40,000. The next year 2% inflation.
I corrected.
Did you fix this already? Okay.
Yeah,
we do some of this on the fly and we apologize. Yeah. It's hard.
No, I corrected this on a past question.
Okay. So anyway, the bottom line is
I got it called in or something.
Okay.
Yeah.
So
I did the math in my head.
Yeah, and you do.
And
that.
I misspoke the number and I corrected it.
Okay. So Richard, thank you for that. He says he has a crappy laptop microphone. That's why he's typing the question.
Okay, well, buy it a better mic with all the money you've made.
Yeah. All right. Next question. Comment. Pardon me. From Teresia from Snohomish, Washington, right up the road. I heard your recent podcast suggestion to borrow from your 401k rather than withdraw in order to cover emergencies. I caution my clients about this as the money will be fully taxed twice. Yes, you get the money without tax when you borrow it, but you're paying it back with after-tax money. I guess that is true. Yeah.
But
and when you withdraw it in retirement, you're paying tax again.
It's replacing after-tax money, so it's actually a wash because it's replacing money you don't have.
The part one, you're going to pay it no matter what when you take it out. Right. That's when you retire. Her point is, if you'd borrowed rather than, right? Isn't that what she's saying? Yeah, rather than withdraw. So, all right. You okay?
You got to screen these better.
I try not to. You told me not to.
No. But
you told me just to read them.
Not all of them.
Okay.
Apparently.
Just read them, but not all of them.
Yeah, only the ones that are like, if they're questions.
Okay. This comes from Michael in Vancouver,
Washington.
Is
this a question?
No, it's not.
Another comment?
Yeah, he said, I try to get it all out of the way. He said, I saw this and thought you would like it.
This is an episode I'm editing because
it's a Facebook post.
Okay.
And I can't go look at a Facebook post because I'm not on Facebook. So I had somebody else go look at this Facebook post for me. Guess what they found?
I don't know, and I don't.
Dad
really care.
jokes. Dad jokes.
Geez. Can we move on? Thank you all for joining us for this episode of a very strange episode.
It was strange, I gotta say. But you learned one very important thing.
So no questions?
Hang on.
I'm going to have to edit this. I'm going to have to edit this episode. I like it when I don't have to edit episodes, but in this case,
this is a long one, though.
It's all right. We have 5 minutes.
Okay, here we go. This comes from Chris Anonymous in Canton, Georgia.
Chris Anonymous?
That's what it says.
Is that his real last name?
That's what he typed.
An anonymous last name? Go ahead.
I'm looking for a bit of advice on investing for a trust. A few months ago, a friend passed away, named me as trustee of her trust. The house is in trust, and I'll be closing the house sale, which will net about $225,000. She also left $90,000 of an inherited IRA as well to the trust. The money is meant to support my friend's son, a 60-year-old that failed to launch.
Wow.
Don't comment. A trustee
won't last long.
I want to give him income from the trust each year. Any expenses of the trust, including income taxes, tax prep, must be taken from the trust balance and not reduce the annual income given the son. The inherited IRA was just moved from Edward Jones, congratulations, who had the money invested in high-cost, upfront, loaded American funds, 50-50 go through the funds. It's the typical American funds stuff. Yeah, American
Growth Fund of America,
blah, blah, blah.
Investment Company of America, Bond Fund of America.
Question. As trustee, I'm responsible for investing. Is wondering your thoughts on how this should be invested. For simplicity, I could dump it all in BND and give the son income dividends each month. By pulling tax and other expenses, the balance will reduce future income. Or should I invest it? You're getting smarter here, Chris. 25% in VT and 75% in BND, with the thinking of growth of VT should offset the annual expenses. I have 10 years to pull from the inherited IRA and will move it over to the brokerage account when I invest the house sale proceeds. She doesn't say how much needs to be taken out.
Yeah,
that's one important part. Because this is $315,000, not a lot of money.
Right. So, and here's my first thought was a contrarian thought. Because this is someone who must have the income from this portfolio. Best case scenario, I believe you're probably looking at best case, being able to provide, without drawing down principal, about $1,100 to $1,200 a month.
So that would be 15 a year on 300.
300 and change. I mean, that's best case. It's somewhere between 1,000 and 1,200.
That sounds right.
Yeah. 1,000 to 1,200.
Yep.
So that's best case.
And however, the fact that you're pulling it out on a regular basis means you need stability.
Right. And it also means somebody has to be in charge of this forever. And that's one of my big issues, is what if there's no one to manage this trust properly if it gets in the wrong hands. Whereas this is one of the rarest of rare instances when I would suggest shopping for an annuity. And an income or an immediate
What's it going to pay
annuity.
out?
It's going to pay out
About what you said.
to
Yeah.
1,800. You see, it's going to pay out about, because remember, they're paying
But
principal.
you're only solving for the one life.
That's all I want to solve for.
And that's
is
what I'm saying. So in some ways, that's an advantage.
That's why I'm suggesting it, because its sole purpose is to provide income for this one life.
That's it.
The best case scenario income-wise, I hate to say it, is going to be an immediate annuity, but you need to shop. You want a highly rated insurance company, and you want the one that is going to give the highest payout for single life. And if you can get an adjustment for inflation, bonus.
That'll be hard to find. I think.
They have riders,
Yeah.
but it means the payment will be lower.
Yep. Yeah. No,
But
I think that's not a bad idea.
I just don't know what else because it's going to be a lot of work.
Yep.
Because this is a 60-year-old who could live until their 90s.
Let's say you're planning on 30 years. That's a lot of income.
Well, plus it's a lot of who's going to manage it for those 30 years.
Good point.
It's work. This takes the work out of it and makes it a one-time event. All your costs, basically you just liquidate what's left in the estate, put it all in that annuity, and wash your hands.
Okay, so where's the best place to go shop for those? Because what, they got Stan the annuity guy or whatever?
Yeah.
I like his work.
Where
do you find
what
the
you want to
best
try
deals?
to find is they have no load immediate annuities.
Sure.
I'm trying to remember who the company was, and it's because I don't talk about them anymore. You want to avoid an insurance agent if at all possible. Fidelity does annuities, and I think they're no load annuities. I'm pretty sure. Yeah, they do. Yes, they do. I just looked it up. I'm trying to think who else does. Oh, Ameritas has a no load annuity.
They've been doing no loads for a long time. So
yeah, so they're out there. Just do some research, but you want a no load. But it's not. I mean, it's not going to be exciting, but it is going to be probably the best way to get a guaranteed income. Because remember, the insurance company's making a bet with you. They're betting he's going to die sooner than later. You're trying to protect him.
but I like that because you're solving for the one life. You're solving for regular income. There you go.
This is a very special situation. It's not a great solution for everybody because the money will be gone when that one person dies. There will be nothing left for anyone else. But that's okay. Okay.
So shop it out. Good luck. Thank you for listening, and thank you for asking for our help. And you as well. Thank you for listening.
Me?
All of you. Thank you for that.
Yeah, thanks, guys.
No, do appreciate it. So,
all right. Now, I've got to go download this thing and edit
Clean
all of
this
Tom's
thing up.
mistakes out. Silly
there's a
comment.
full-time job for you.
Golly. Thank you all for listening. And remember, we're here pretty much every day, except for, when there's a technical glitch or something, talking real money.
The opinions and views expressed on this podcast were current on the date recorded. Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions. Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy. Information presented on the podcast is not personalized investment advice from Appella Wealth. The views and strategies described may not be suitable for everyone. This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction. Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appella Wealth, a fee-only registered investment advisor. Please see Appella Wealth's ADV Part 2A on our website for information regarding Appella's fees and services. Appella Capital, LLC, DBA Appella Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Appella does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit TalkingRealMoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. Is anybody still still listening?